Let me call my august panel to take their hot seats here, please. I think why don't you all sit and I'll introduce you as you come. Please, Piyush, Hemal, Mayur, and Tejesh, please. Before I start the panel discussions, let me introduce the panel. Of course, for a Mumbai audience, I don't need this panel requires introduction, but it is my protocol to do so. I'll start from here. Hemal Mehta. Hemal is the CFO of alternatives at Edelweiss Alternative Asset Advisors Limited. He has over 25 years of diverse experience, which from various functions, which is finance, accounting, tax, operations, risk and compliance, investor relationships, specific to the asset management and real estate and also in other industries. Prior to joining Edelweiss, Hemal was with Kotak. He's a qualified chartered accountant, not only from ICAA, but also from ACCA UK. And interestingly, Hemal has worked in many geographies, of course, India, London, Mauritius too, and Dubai. Hemal, thank you very much for joining us. Going in the same order, I'll introduce Tejesh Chitlangi. Tejesh has been ranked as the global elite thought leader, as well as the first and only Indian lawyer to make it to the Asia Pacific Top 2023 list, Top 10 list, particularly in the category of funds regulatory lawyers by Who's Who Legal. There are many more global rankings, particularly when it comes to the that particular space of regulatory lawyers. We are absolutely happy to have Tejesh with us. He also brings a vast experience in the Indian offshore and investment funds structuring space. Importantly, Tejesh is a very important interface for the investment community, particularly with the regulatory bodies here. He's part of many policy initiatives, and currently he's also part of the all-important SEBI Alternative Investment Policy Advisory Committee, APAC. Pleasure to have you with us, Tejesh. Moving to our key asset manager in our panel, which is Piyush. Piyush is the head of credit markets at Investec. He's the CEO of Investec Credit Finance Limited. He has over 25 years of experience in the Indian and Asian credit and fixed income markets. Prior to joining Investec, he was the MD and head of fixed income at JP Morgan and MD and co-head of global markets at Deutsche Bank. Again, he's a policy influencer. He has served as the member of SEBI Committee for Corporate Bond Reforms in India. Thank you, Piyush, for joining us. Last but not the least, Mayur Gala from Pricewaterhouse and Company LLP. Mayur again has a long years of experience in advising several financial services players in areas of stressed asset, credit funds, ARCs, NBFCs, private equity, venture capital, real estate, and capital market groups. He also specialist in local tax and regulatory compliance matters. We'll pose some questions for him. Again, another one of our panelists who's extremely connected in contributing towards policy initiatives, working with the regulators. He has been part of the IFSC Gift City Committee on sale of stressed loans to IFSC units. So we'll ask him something about IFSC. He has worked closely with the NBFC industry players for review of the RBI Usha Thorat committee report and representation to RBI, and also worked on the SEBI representation on KM Chandrasekhar committee on rationalization of investment routes with regard to FPI regime. So you all will agree that is an absolutely august panel, possibly the best I have moderated. Thank you very much, all of you, for giving your valuable time to us for this evening. So with that, let me kickstart the discussion. Maybe what I'll do is, we'll start again like Justin beautifully said, the global context. Clearly private credit is a secular change, and with the changes in the markets, it's clearly visible now. I'd possibly start with Piyush. and basically request Piyush to share with us what is driving this growth. I mean, the more and more we see, surely there is in India also the growth is picked up. So can you share with us, Piyush?
Sure. So I think Justin, in his presentation, touched upon the various drivers for private credit globally. I think the drivers for India are also broadly similar, while we have some unique local drivers as well. So just like globally, I think post the global financial crisis in 2009, banks started becoming more and more regulated and facing capital restrictions increasingly under Basel III, etc., and therefore had started vacating the mid-market lending space. And that combined with the whole exponential growth of private equity as an asset class in the last decade or so, and with that, the private equity funds requiring non-bank type of solutions, the unitranches, stretch senior, second lien, term loan Bs, junior tranches, etc. So all similar drivers exist in India as well now. Here as well, I think after global financial crisis, we saw a loose monetary policy being pursued by central bank like everywhere else, which led to, one can in hindsight say, some indiscriminate lending, especially by public sector banks. And then that started showing up in the NPLs in 2013-14 onwards, as a result of which public sector banks particularly started vacating the whole mid-market lending space. That space temporarily for a few years was plugged in by NBFCs who were running ALM mismatches and easily 3-4 times leverage on the book on an average, which went on till 2018 when the largest NBFC in the country, which was ILFS, ran into the issues that it did. Post which the NBFC's wholesale lending model was also broken. They vacated the space. Credit mutual funds, again, post events of ILFS and what happened with one particular fund during COVID, as we are all aware. I think that market bid also kind of contracted significantly, on the private credit side. And corporate bond market has always been, relatively under-evolved in India. I think we've all been hearing and talking about potential reforms and deepening of corporate bond market, but we haven't really seen that happening. So even today, it doesn't really go beyond a AA rated bond. This combined with the fact that banks in India regulatorily cannot do certain end users. They cannot finance an M&A by way of acquisition of shares or stake buyouts or refinancing in certain ways. There are certain restrictions, bridge financing, etc. All of these have led to a gap and void in the market, which is now being plugged by private credit finance providers. I would also add here that India, again, is a bit of an exception. I think one of the slides, Justin, that you put up, which showed that how a lot of private credit allocators are allocating, of course, in their domestic markets, but outside of the home market, US is the largest destination of private debt from Europe and Asia, etc. And I would probably just top of my mind think that probably is attributable to the fact that US has a very large footprint of mid-market businesses. So just in terms of deployment of capital, US can absorb much more capital. And similarly, India, I think outside of China, is probably the only market in Asia Pacific which has such a large mid-market footprint. I mean, if I look at just profitable companies between, let's say, $50, $100 million to $1 billion top line, proper mid-market, we are talking of thousands, not hundreds of companies here, across different types of sectors. And banks, are not lending to these by and large. Corporate bond market doesn't exist. So that combined with the end-use restriction, I think these are the two main drivers. And then on the investor side, particularly on the wealth, which is the main bid right now, last couple of years for private credit in India, I think the whole taxation break that was available to market-linked debentures and income funds, which was taken away earlier this year, I think that has led to especially the HNI and wealth segment family offices to search for extra yield. The asset class in general globally has, of course, performed well. We saw a slide that Justin put up, so I think there are enough data points which show that the asset class has actually, in terms of absolute losses as well as volatility adjusted returns, has actually outperformed public trade asset classes globally. So I would say those are the various drivers that are driving the growth in India for private credit.
Thank you, Piyush. I think you beautifully covered the entire structural arena of private credit. I'm going to come back to you to make some future predictions, and that insight about mid-market is a very important one. Actually, it's an original one, because it's surely private credit requires a mid-market to absorb. I think it's a beautiful observation. Continuing with the context setting, I'm going to switch to Tejesh. Why? Because Tejesh has deep experience with institutional investors, advising them on this asset class. So I'm going to ask him, how does this asset class appeal to investors? So if you take it from the investors.
Sure. Thanks, Sridhar. I think there are a lot of factors which we come across when the institutional investors are putting money in private credit funds. If you see who are the significant investors in this particular asset class, and you look at category 2 alternative investment funds in India, there are insurance companies, both life and general, who are putting a lot of money into category 2 private credit funds. The likes of SIDBs, SRIs are putting a lot of money. Even banks are taking exposure, which otherwise they don't take in, say, the private equity or venture capital. And you are also talking about large family offices who are significant investors in the private credit funds, and for a variety of reasons. One, the kind of regular coupons they are able to earn from the private credit funds, something what they have not seen in other asset classes. All these investors who have put money in private equity, venture capital funds, or public market funds, they have not seen the regular payouts to them. A private equity fund, which is a 8-year or a 10-year tenure fund, or a venture capital, which is a 10+2 sort of a model, you're seeing the color of money only towards the end of the life cycle of the fund, right? When you're looking at these private credit funds, because the nature of the underlying security in which the investment is being made, a typical non-convertible debenture, the way they are generally structured is you are getting, say, a quarterly coupon payout. So if you are investing into a 12% sort of a coupon, you are actually seeing a 3% sort of a regular coupon on a quarterly basis being paid out to these investors. And when we discuss with dozens of these investors, and this is something their investment committee is really like, that every quarter they are actually seeing the color of money. Second, these are limited tenure vehicles. Of course, all the private equity venture capital funds are also close-ended in India, compulsory by way of SEBI alternative fund regulations. But here you are seeing a 5-year or a 6-year sort of a tenure vehicle, and not like 10+2 or 9+2 or 8+2, like typically what other funds are. And obviously, there are added features, again, coming to the nature of instruments, because the fund managers are able to churn the capital again, right? The reinvestments, which typically all these fund managers end up doing. So even for a 6-year sort of a tenure or a 4-year tenure, actually you are able to churn the capital twice. So 500 crore sort of a fund in India, you would end up deploying, say, 1,000 crore because of the nature of the vehicle. How it benefits the investor, because they have carried out a due diligence on a good fund manager. They have faith they can put money in that particular fund, and they are not able to look out for different fund managers, right? Because they know that for the 6-year period, I think a 500 crore or say a 50 crore or 100 crore investment by them is going to give a yield, a result of, say, a 200 crore investment, right? Because capital will be churned twice. This is not something which investors are appreciative in a private equity or venture capital fund, because of the nature of the vehicle. Again, going back to certain regulatory aspects, the kind of regulatory sort of leeway which a domestic alternative investment fund regime accords to the investor, that's not something which FPI regime or a ECB regime or say an FDI regime can give, right? For example, if you want to give exposure to Indian debt market to overseas investor, and if they have to invest under FPI route, then a foreign portfolio investor cannot take more than 50% exposure in an Indian debt instrument. If you want to do that differently, you have to get under VRR, which is a voluntary retention route. You have some lock-ins which are there, say 3 years, you have to be invested in India. But if you look at those regimes, there are a lot of other restrictions, right? End use restrictions, what coupon you give out, a lot of such factors which have to be taken into account. Moment you route that money through an Indian alternative investment fund, which if you see is a preferred model with a lot of global giants who are investing in India. There are large pension funds who are investing money in Indian credit market. There are large global institutions who would have seen taking large exposures here, and they are finding this domestic route as an alternative to even FPI route. Because the moment you route the money through an Indian AIF, there is no 50% norm, right? AIF can be a exclusive subscriber to the entire debt issuance here, right? There is no lock-in. You can have a tenured, say a 1 year sort of a debt instrument. You can get the redemption. You can design it the way you want, that you want redemption towards the end of it, or you want regular coupon payouts. There is a flexibility to, of course, structure it favorably from a tax perspective. And these are tax pass-through vehicles, which Mayur will talk about more. So quite a few of these features make it pretty favorable for the private credit industry in India. And since the regime is emerging, there are a lot of new innovative models which are coming out in the market today and which are keeping the institutions in particular pretty happy.
Thanks, Tejesh. Wow, you really covered the gamut of it's surely a secular change. It looks like all investor classes are, and there is surely this aspect that Justin touched in terms of current return. The churn is I didn't realize that because of the time thing, and the route itself seems to be a better one than what they can choose. Thank you very much. It is insightful. We'll come to the part of the future with Piyush shortly. Maybe it's a good time now to move to Mayur and ask, obviously, with all our audiences, while the context is set, they obviously want to know which would be the most optimal jurisdiction to structure private debt transactions. And based on your experience with various clients also, is there a preferred one to structure these things, Mayur?
Yeah. So, I mean, there is, unlike, I can say, a decade back, where, we used to identify jurisdictions based on what's more advantageous. We used to look at a rate and say that, this XYZ, Mauritius, Cyprus, Singapore, used to be the usual norms. Again, a secular change. At a fundamental level is substance over form. That's come in every single thing that we're looking at. So just as we say the businesses are evolving, just as we see the structures are evolving, similarly, even the tax regime or the authorities, effectively everything is known in terms of how things are happening. And therefore, even when we look at a jurisdiction, it's no longer about should I just look at X versus Y versus Z because that's more attractive, or that has all the benefits that it's providing to me. It's really about is it a substance versus form in terms of is it real in terms of what is happening over there in terms of how are we doing things, or is it really a flow through? Because if it's a flow through, looking at the way Indian authorities or the Indian tax system is evolving, looking at the way OECD is moving, the anti-avoidance rules, multilateral convention, all across the globe, it's all kind of coming together. So it's a matter of time. A lot of short strategies that were working very well a decade back are no longer going to work. So you could have the fund managers which are eventually located in say US or UK may very well have a fund based there because you have your key team, the core team sitting over there and the investments happening, and you get the same benefit of 10 or 15% on interest, which is what you get somewhere else. You could even focus on some of these regional jurisdictional platforms that we have, whether it's in the Netherlands, Luxembourg, Singapore. But I think the key part which comes out is it can't just be an entity from where you're just routing the money. I hire people, I do whatever I need in terms of paperwork. That's clearly out of the radar. Clearly, there are two key streams when we look at these structures that we kind of filter in is pooling and people. So if at all I'm raising funds, am I having pooling in that jurisdiction from where the money is coming? Are LPs coming in that jurisdiction? If not all, certain LPs are coming in. If not LPs are my multiple jurisdictional funds getting pooled. So that brings the rationale of why do I need a third jurisdiction. So that pooling is one of the critical parameter that comes in. And people, am I having people who are running that show, in that entity, in that organization, in that location, who are critical to the business that is happening in India? I mean, it can't just be that, I hire two people and get a senior director sitting, in a third jurisdiction and get all the paperwork in place, And the reason, I say this is not theoretical. We're seeing tax assessments happening for funds which are in the non-anti-avoidance era, which was the safe zone. And it's still not gone to all jurisdictions. It started with a few. But the tax authorities have reached a level where they're saying what's happening in that jurisdiction, who was involved, in this transaction, share correspondence of the investing jurisdiction people with the negotiating team in India. That's the level at which the tax authorities are kind of going in. So it's no longer, a conceptual point which advisors used to talk about. It's something that we're seeing on the ground, and therefore, it could be anywhere. It could be Singapore, where you have your entire regional base with the team, with some sort of LPs coming in together. It could be, it could even be Mauritius for that matter, because Mauritius is, wonderful when it comes to several other aspects, but it can't just be an SPV through which the funds are being routed, So, in that sense, jurisdiction is flexible, but I think there's a lot more needed to be kind of built in now.
Thanks, Mayur. That's a cautionary advice for free. Take it seriously. Coming to Hemal, I'm going to cover that part in continuation. From the structuring side, in the 1 week I've been here, I mean, we've heard a lot about GIFT, Hemal. So does GIFT jurisdiction provide us better opportunities to structure private credit? Based on your experience, I know you're looked at the jurisdiction very much in depth.
Yeah, Sridhar. So let me first clarify a few things before we go to GIFT. I think we all are hearing private credit a lot. We're reading it a lot in the newspapers also. I think this was always existing. It used to be called structured credit. Now, all of a sudden, we hear private credit, private credit. Now, why it is picking up that much in India, and I'm sure I'm just adding a little bit to what Piyush said. This is flexible capital. Why banks are not able to do this is very important to know, right? Because for a bank, you need to have a standard schedule which needs to be maintained in terms of repayment. Whereas for a fund, you can be more flexible. It can be back-ended. You don't need to have a definite amount schedule, and you won't be classified as an NPA if you miss one or two repayments. So that's the reason most of the borrowers like this space. And that is the reason this is picking up big time in India, because there is flexibility involved in this capital. Now, coming to the point on GIFT, I think the GIFT in true sense is GIFT for India and for the global fund managers, and also for the domestic guys who are looking to actually raise capital and invest offshore. Predominantly what the government has done is, it has taken some time. Actually, it's taken almost 5 years to see the light of the day, because there were a lot of things which the industry asked for. And every budget we used to wait for that announcement to come, whereby, all our ask would be taken on board. But the most important part on GIFT is that any income made by any investment manager or the fund manager is completely tax-free for the first 10 years out of the 15 years which you choose from. That means that practically all your incomes are tax-free. So you don't need to basically pay whatever. If you're in Singapore, you pay 10 to or 17%. If you're in Mauritius, you would pay whatever, I think 15%. Whereas in India, for the first time ever, this is completely tax-free. The second very important thing is that there is no GST on any of the services which is being provided out of GIFT. Now, that's a fantastic add-on to your overall return at the fund level. And that what it means is that once the fund makes a better return, the investment manager, in effect, will make a better return, because definitely it adds to his carry. So that's one very big thing which the government has done. The third important thing is, especially on the private credit side, the tax rates, so the withholding tax. So if you distribute interest or redemption premiums or any sort of money from India to a jurisdiction like Singapore or any other jurisdiction, if you were doing a direct AIF and distributing to a Singapore-based investor, you would have to withhold 15%. Whereas if you are having a vehicle from GIFT, you have to only withhold 10%. So that's a great amount of saving as far as the overall returns to the end investor is concerned. Of course, the tax-related certainties are also added there, so you don't need to rely on various tax treaties which the government has negotiated with various jurisdictions. So I can go on and on because I think what has come about is something fantastic for this industry. And I think all the guys, whoever is a global fund manager needs to evaluate this. And I'm sure a lot of people are doing it. But I think this is here to stay. And this is going to become big for the country.
Thanks, Hemal. As an ex-banker, I can agree. I think flexibility is a very important part private credit brings to the table. And I think, Atul, you should start celebrating. Your license at GIFT has come at the right time in terms of... but clearly, and of course, the withholding tax in Mauritius is now 7.5%, but you beautifully bringing in the other parts which actually enhances the yield and makes it much more interesting in GIFT, and that's something which we need to. I'm going to turn and ask you the next question, which is more a little bit on while we all agree that this is a happening asset class. I think particularly from your perspective, from the asset manager's perspective, how can we manage this asset class? Particularly, lean operations is a very important part of managing any private assets. And what role technology plays here? Is there any guidance? Can you give us?
So I think the way we split ourselves is there is a front office, which is the investment team and the deal team, and then there is a back office, which is the operations team, right? As we grow on the fund side, I think we've seen globally also that the operations team need not grow, right? What you do is tend to outsource. And that is where exactly to the likes of IQQ and the various other service providers actually play a very critical role to support this ecosystem. Technology per se, I think, is equally important at the front end for the guys who are on the road, raising capital at the same time doing investments, because you go and negotiate a transaction, you want every deal, whether it's in the pipeline stage or whether you've actually invested everything, to be monitored on real-time basis. Especially on the private credit side, what is very critical is that as you keep getting coupons and there is an amount schedule which is already negotiated upfront, you need to have right in front of you at any given point in time and see and compare that what was agreed upon and what has come to you. Is it in line? Is there any overdues? And you need to have some real-time information. Even technology can play a great role for doing valuations of private credit, because you don't need to have difficult models here, for unlike the private equity where you will have to have various sorts of model to actually value a company. Private credit, for that matter, is very easy to do valuations on the credit side. So I think technology has to be the backbone. Of course, I think just to touch upon from the service provider perspective, what we rely on. So me as a CFO for the largest alternative space in India, at least, what we bank on is the platform which our service provider provides, mainly to do regular accounting on all our positions in the fund, to give us regular reports, to do investor servicing. And also there is something called as, international LP agreements. There is a body under which there are a lot of reports, standard reports, which needs to go out to all the investors. It's called INPA reporting. So all that can be customized and can be sent out right from the system rather than manual intervention, and which leads to a lot of confusion at some point. So I think technology is extremely critical to start with on the private credit side, because on the private equity side, you have a lot of time to actually churn out things and then to report. Whereas on the private credit side, it's literally real time. our investors basically expect, can you please tell us what are the MTMs? What are the HTMs? We would like to know what if these coupons are prepaid? What if this happens? What if that happens? And if you don't have a great technology base to answer those queries, I think you will definitely lag. So technology is extremely critical.
Thank you, Hemal. That I think these are really valuable insights, and particularly an asset class which has a great future. If we do it in the right way, we build investor confidence. I'm going to switch now to Mayur because I want to ask about, as an advisor, what would be the key aspects which matter in a robust deal process when it comes to private credit, Mayur?
Yeah. So in a deal process, I mean, I would look at it in two buckets. One is a deal process in terms of the process of how a transaction is going through as part of the fund or as part of a transaction team. And the second part is when you're negotiating a transaction, a specific deal. While that process is going on, again, how that becomes critical, and especially when I look at tax here. Generally, the usual norm is let's first do business and tax will come eventually, and let's look at it when the docs are ready. We'll go through all of those, the standard reps, warranties, but things are changing now. I'll tell you why first before I come to this. We spoke about 7.5%, we spoke about 10%. All of that can jump to 40%. That's the extreme of private credit tax in India, because an investment that comes in India either through an AIF, or the structure can range from it being 0, 7.5, 10, 20 if it's an FPI, or can go as high as 40. And if it's 40, then all the great calculations, IRRs that we try and do can go for a toss. That's one extreme. The second extreme is, the way India was looked at earlier is, can I take X interpretation or a Y interpretation on the tax side, and can I just go ahead? Is it okay? You go to an advisor saying, is it worthwhile? Can I take a chance? Will I eventually be able to do it? That mindset is changing because any litigation in India, basically can go extremely up to 10 to 15 years. And with a fund cycle of 7 to 10 years, you're not going to do a deal in India with an interpretation to say, I'll sit and litigate on this. Last budget, the tax office changed the law to say that I can reopen a case going back 11 years. And in a fund structure, you paid out money and you're sitting as a GP, you don't want those. So therefore, any decision that is taken on the tax side has to be with a clear conclusion to say that, is it black or is it white? The moment you go in the gray zone as a fund manager, that's an extremely difficult situation to be in, which is where in a deal process, when I'm doing a transaction, there are two parts to it. If it's a foreign fund which is investing in India, it's very critical in terms of who is doing what. There are a whole host of issues that come up, because especially if an India team, which is sitting on the ground, what's the role of the team? Is there a negotiation happening? Is there diligence happening? Is there a contract being concluded? And we know how transactions happen, while there's a paperwork, but at the same time, it's quite real time. So how is the process actually running on the ground in terms of who does what in terms of in India versus outside India, and what's the documentation around that? A lot of decision makings in minutes is what we've all seen. A lot of it remains the same. The number of shares changes, the number of debt changes, the return changes. A couple of paras get added in the minutes. That's not enough to a great extent. Because if you're looking at the investing entity being involved in a transaction, clearly there has to be a lot more happening in that entity. There's a lot of involvement required in that entity. And in several cases, we've seen that involvement is there, but the paperwork, sometimes is not supporting it. And which is where, unfortunately, the challenge comes, because without paperwork, you can't really prove a lot of these things happening. So a deal process with a robust documentation is become extremely critical. And unfortunately, it's a lot in India than other geographies. We've seen many of our funds saying, why is India being so fussy about things where across the globe, things are moving very fine. But unfortunately, it's become a norm and a need, given what is happening. Moving to the other part, while you're doing a transaction, typically, I would say even at a term sheet stage, negotiating tax or tax related nuances again is an extremely critical aspect, because a lot of these private credit transactions may not necessarily be plain vanilla debt transactions. There are back-ended coupons, there are moratoriums, there's a structure, there is a ballooning, there's a payout mechanism where it will periodically become due, but the payment date is deferred. So all of these interesting products that have come, which the flexibility of credit adds to the complexity of tax, because what is the stage at which the tax will become applicable, is equally sensitive, and therefore how are you doing the documentation, is it robust or not, becomes very critical. You negotiating the right indemnities early at the stage is much simpler than doing it at the last day, because then you will not be able to negotiate it. Indemnities can go back to as much as 11 years. Again, identifying the right target, right fund with, which works commercially as well as balances tax, becomes very critical, which is the reason both at the deal stage as well as the fund stage, tax is becoming critical to be, kept in place right while the commercials are being negotiated, because a lot of it, is not really about, litigation. It's about, taking the decision right away.
Thanks, Mayur. I think there's a clear correlation and towards how we structure it, what is the paperwork we do towards the IRR which we are projecting on this. So I'm sure there's a lot to be careful. Again, going back to a little bit of Tejesh, we are not going to let you without some insider information of what the regulator thinks. Given that you work very closely on regulatory initiatives, we're going to ask you, how does the regulator approach this fast-growing asset class? Any insider information you can give us?
See, I think regulators are bound to get very inquisitive if there is a sudden rise in a particular asset class and you see numerous funds coming in the market actually with a lot of innovative structures. And I'm pretty sure, like, without taking any names, and quite a few here in the audience would have read that what's in the limelight right now is close to a dozen funds which are being investigated by SEBI, actually. And where Reserve Bank of India had a lot of reservations, and these are the kind of complaints which have emanated from the RBI. And typically what you have heard is the evergreening of a few debt transactions, right? Now what happens is that when regulators start getting inquisitive, and not only they start receiving complaints from the investors or the clients of these funds for a variety of reasons, but also when the other regulators actually get interested that they are seeing some regulatory arbitrage happening, and another regulator's vehicle being utilized to actually do a few things which, if not in letter, but not in split compliance of their regulations, then these things will happen. And otherwise, the very legitimate structures or structures which are completely otherwise kosher under the regulations are looked into with a lot of suspicion by regulators. And I will give you numerous examples. If you would have seen, there a lot of venture debt funds have been launched. There are a lot of revenue-based financing sort of funds which we had launched, and regulator had given an approval, but later they got very inquisitive. And when you're talking about, say, a revenue-based sort of alternative investment fund, then you're starting with a lower coupon. But what you are doing is that with the rise of the revenues in the portfolio entities books, actually your coupon can go up. So it's not a fixed sort of a coupon, but it is a fluctuating coupon wherein you have got a floor. So you are protecting your base, but it can go as high if the underlying portfolio entity is performing well. Now it's completely kosher under the regulations. There is no law under Companies Act or under SEBI AIF regulations or any notifications which debars any kind of a structuring of this manner, right? Now you would have heard of a lot of the senior junior tranche structures which had been set up by loads of alternative investment funds. We have done a dozen of them, and completely kosher. You're not taking regulatory interpretations there. They're perfectly legitimate from a regulatory standpoint. But suddenly regulator is getting interested that why you should have a senior or junior tranche, why should one class of investors should have a priority payout. Now these are all commercially justifiable structures because you're offering it to all investors in most of the cases and telling them that, look, it's a good fund manager is offering, so your money is not going anywhere. But if you want a lower fee sort of a module, it can be in form of a carry or management fee or op expenses or whatever. But then you will be participating in a junior tranche. You will be receiving money next to the senior tranche investors, but they are paying much more fee to the investment manager. So these are commercially justified structure. And if you even see in the US, wherein the new rules have been formed or amendments have been carried out in the Private Advisors Act, The regulator, even SEC, is very clear that as long as you're not discriminating between investors and you're offering a particular sort of a product to everybody, and investors can pick and choose commercially that which one they want to subscribe. Actually, if they are willing to go to the junior tranche because they have a lot of faith in the fund manager, it's perfectly legitimate. And in fact, you talk about the earlier OPEC or the DFC right now, the US government, clearly the institution, they had this model that, look, you give me my first 8% IRR right in the beginning, post return of capital, before you pay out coupons to other investors in the fund. Now, if your fund ends up making 14% or 16%, I don't care. I want my 8%, and thereafter, my money can go to others, right? So all these kind of structures are globally prevalent. These were okay with SEBI, but suddenly SEBI came out with a notification. They got really inquisitive that, okay, what's happening? Because SEBI believes that they follow a blind pool model, which means every payout has to happen on a pro rata basis of the commitments of all the investors. So if you are giving a priority payout to X investor, even though they have commercially agreed across the fund, but they believe that in order to do that, you are sharing a pro rata portion of somebody else's money with them, which is not legitimate under SEBI AIF regulations, basis some interpretations which, like, I don't want to comment on. Now, that circular still stands that if anybody is following a priority payout model, they can't do fresh drawdowns, they can't make new investments. And we have a status quo right now. So there is no progress which is happening there. There is a consultation paper which came out, but again, nothing is happening there. There are a lot of regulatory working groups I am a part of. The debates are still happening. There is no conclusion. But the point being that there are a few wrongdoings which will happen. The evergreening, going back to what I was talking about, where RBI and SEBI are getting very interested. But if you are trying to prevent NBFC sort of a default because they are invested into bad quality asset, and you are floating an alternative investment fund trying to transfer everything from the NBFC, doing associate related party transactions, and actually trying to give an exorbitant 20%, 22 or 18% payout to a priority investor, actually. And even the promoters are putting in a question of saying that, okay, your 20 or 22% is secured for a year or two, or whatever. I am putting in 300, 400 sort of a crore in the fund, and you are trying to prevent a default by the NBFC. So this is what RBI believes as evergreening, and they will say it's in spirit non-compliance of the laws. In letter, it may be compliant, in spirit, it's not. So what bad happens is that the otherwise legitimate structures also regulator starts looking at with a lot of suspicion, right? So as an industry, it becomes really critical that when SEBI comes out with consultation papers, you have to really go out, put your comments in public domain, tell SEBI that, okay, as long as disclosures are in place, there are no conflict of interest situations, there are no associate sort of transactions, then regulators should be more pragmatic, right? So right now we are at that juncture wherein regulators, because of the like exorbitant growth of the asset class or a quick growth of the asset class, are looking at a few of the otherwise legitimate structures with suspicion, but industry needs to come together, make representations, go to the regulator, and they are all ears actually. They will listen and try to see that how commercially viable structures can continue and not get marred by a few bad incidents in the market.
Thanks, Tejesh. Clearly, Big Brother is watching. And maybe one advice I can give is maybe ex-bankers should not set up private credit because they follow the bad practices, what they did in banking into private credit. Just joking. I'm going to wrap this session with Piyush, and then we will have some questions. Keep your questions ready. Piyush, I just want to ask you, first of all, there's a lot of interest here. Is there overcrowding your view? Does the market can accommodate all this interest in private credit? And connected to it, can you make us share with us a prediction of where this market is going to go in 3 to 5 years?
So, I think there has been a lot of there have been a lot of announcements of new funds, especially over the last, I would say, 18 months or so. A lot of first-time entrants have come into this asset class, many of whom have not underwritten this asset class before, many of whom have just kind of bolted on a private credit fund because they have a wealth platform and they can raise funds from their wealth clients. So, for various reasons, there have been a big proliferation of first-time entrant and new funds in the last 18, 24 months. And when I say first-time entrants, I don't mean people who are doing fund, who are going to underwrite private credit in fund format for the first time, but or rather, what I mean is people who have been underwriting earlier but are going to underwrite in a fund format for the first time. That's separate. but people who have never underwritten private credit before. That's what I'm talking about. So yes, there is clearly some amount of crowd that's setting in. Having said that, let's just take a step back. First of all, is the market growth big enough? So the answer, to my mind, is a definite yes. If we look at the various segments of the market from where the demand for private credit comes. So let's say M&A, as domestic M&A is give or take annually $60 billion kind of volumes. If you take 1/5 of that as mid-cap and take 1/5 of that as debt financing, you're talking about 25,000 crore per annum just for M&A financing. Similarly, private equity exits, where promoters give exits to private equity, or there's buyouts through private markets, not public markets. That has been give or take $7 or $8 billion a year. Again, attributing some part of that to mid-market, some part of that to debt financing. You're again talking about easily 5 to 10,000 crore there. Similarly, triple B and single A companies who need refinancing, who need some amount of growth financing, equity financing for some of the new capex, and so on and so forth. Similarly, on the private equity side, I think that asset class in India, like globally, has grown significantly. We now see about $35 billion is the run rate currently, annual private equity investments in India. I'm not talking about VC, just traditional private equity, which makes India roughly about 6 to 7% of global annual private equity investments. Blackstone, put out a LinkedIn post about 3 weeks back announcing that India is now their largest non-US country in terms of their private equity investments. So all these private equity funds, as they make investments in India, they are now increasingly taking leverage in their decision-making, matrix. And besides the typical senior first lien financing from banks, they are resorting now to stretch senior unitranches, junior tranches, etc. While it's still just a start that we are seeing over the last 2 to 3 years, but I think the sheer volume and growth would kind of drive that and make it rise in consonance with similar growths elsewhere. So that's another growth segment. So I think there are multiple. And overall also globally we have seen from global financial crisis onwards, I think we've seen roughly 14 to 15% being the year-on-year growth rate in overall private credit. That includes direct lending and mezzanine, special distress, everything. If you just take direct lending, that has just tripled in last 13 or 14 years. So, and India growth rate wise, the economy on the whole is growing faster than other places. So there's no reason for us to not be very optimistic here in terms of the overall market growth. So is there room to accommodate everyone? Yes. Having said that, I do think, since the other part of your question is, how this market may evolve over the next 3 to 5 years, and hazarding a guess there. So I think while there's room for more players, having said that, I think for multiple reasons, I do expect over time consolidation, and concentration to play out, and probably half a dozen, maybe 6, 8, 10 players to kind of stand out from the rest and able to scale up much more than a lot of the others, and some of the others may just fold up and may not get beyond the first one. And there are multiple reasons for that. Like I said, some of these are first-time underwriters of private credit. And while it may look a lot simpler from outside, there are, of course, like any asset classes, it has its own complexity, nuances. Especially in performing credit fund, you have one bad underwriting decision and your entire returns are wiped out, may even go into negative. So the alpha for, in some of these particularly performing asset classes, not in solving for equity upside at times, but more in terms of avoiding losses. So, with all this private equity funds coming in, raising a quick buck on the back of a wealth bid, domestic wealth bid, there will be deployment pressure. There are bound to be some underwriting mistakes that will happen over time. And, for that reason, the track record then, may not stack up for a second fund. That's one. Secondly, I think even in terms of fund economics, I think a 500,000, 2,000 crore fund by itself is not going to really, after paying the distribution costs to the wealth distributors that you have, funds who are just relying on domestic wealth bed will not be able to sustain beyond, unless they properly scale up. And I'm sure as underwriting losses come in, investors will also get more discerning. Right now, they're just going by the advice they're getting from their regular wealth platform, but they will need to get more discerning in terms of the underwriting, past track record, or how differentiated the origination strategy of the fund manager is, etc. So for all those reasons, I expect a few players to stand out and scale up much in a much more meaningful way than some of the others. And I think over the last 2 or 3 years, we've seen some similar trend playing out globally as well, where fundraising has become a lot more difficult for, I'm not talking about private credit in particular, but even on the private equity or some of the other asset classes. While for the first time entrants, it has been a little bit more difficult, but the larger funds are just getting, finding it easier to raise more and more money. So that's on the market growth. The second aspect in terms of, where we could see it going or where we would want to see it going, and I think some of the aspect that Tejesh spoke about, so the regulatory side, I think there's a lot of work in progress here. So while structured finance, as Hemal mentioned, has been around, but a lot of it is now happening in terms of fund format. A lot of new announcements, which is making regulators sensitive, because a lot of this is being sold into domestic HNIs, while they're supposed to be sophisticated investors, but it's kind of, from a regulatory point of view, maybe semi-retail in some ways. So for multiple reasons, there's heightened regulatory scrutiny, sensitivity, and we have seen, multiple, more than 24 circulars coming out from SEBI over the last, 12, 15, 18 months, and a lot of it is good stuff, putting the housekeeping in order, and, hopefully that contributes towards laying a strong foundation for the whole AIF industry, for private credit over the next 3 to 5 years. Having said that, I think we would definitely like the regulator to, again, chop some more wood, especially, for example, the aspect that Tejesh spoke about in terms of tranching, which is pretty much a very basic part of the toolkit. But unfortunately, the regulator has painted everyone with the same brush because of some evergreening issues, etc. Similarly, perpetual vehicles, listing frameworks to be announced by stock exchanges for listing of AIFs. So hopefully, on the regulatory side, even on the IBC side, I think with some of the amendments that are in the works and the judicial jurisprudence, which is evolving over time, IBC will get more teeth, which will hopefully also increase the risk appetite. So I think on the regulatory side, hopefully we will have a sounder and more solid, more evolved framework in 3 to 5 years. I think last bit I would say is that the market would, while wealth and HNI is the flavor of the season right now, but I think eventually to scale up, that can't be the cornerstone bed. And I think the domestic institutions, for example, is very underpenetrated. Institutional capital, while some funds, of course, have a many-year head start, but others need to catch up as well, while international investors, LPs, from a relative value point of view, may not find some parts of the market attractive, but hopefully with rate cycle changing, that'll change as well. So I think on the whole, we will see more institutional capital coming in as well, which helps some of the funds scale up as well.
Thanks, Piyush. I think Piyush, you really unpacked the growth and also laced the optimism with caution, and also suggested what type of structural changes which should happen. Thank you.